Welcome back to Invoice Finance Explained by MarketInvoice. I'm Adam Parker, and joining me as always is Oliver Mackman. Today we're getting into one of the questions we see most often when business owners first start exploring invoice finance. What is the actual difference between factoring and invoice discounting, and which one makes sense for your business? It sounds like a simple distinction, but there's a lot of nuance in there, and it's one of those things where people think they understand the difference after reading a 2-paragraph explainer, and then they get into a conversation with a provider and realize they had half the picture. The terminology alone trips people up. Exactly. So before we get into the detail, a quick note for listeners: everything we discuss today is general information. It's not financial advice, and you should always speak to a regulated financial professional before making decisions for your business. MarketInvoice is a comparison and information service, not a lender, and you can find our resources at MarketInvoice Co. UK. Right. So Adam, let's start from scratch for anyone who's completely new to this. What are we actually talking about when we say invoice finance? So invoice finance, at its core, is a way of unlocking the cash that's tied up in your unpaid invoices. You've done the work. You've raised the invoice. Your customer has 30, 60, sometimes 90 days to pay, and in the meantime, you've got wages to pay, suppliers to pay, you need to buy materials for the next job. Invoice finance essentially lets you access most of that invoice value up front, before your customer has actually settled, and the UK market for this is genuinely substantial. It's not a niche product, not at all. The UK finance data puts the market at around £20 billion advanced per year, and there are approximately 40,000 businesses using invoice finance across the UK. Around 85% of those are SMEs. So when people think of this as some arcane corporate finance instrument, it really isn't. It's very much a mainstream tool for growing businesses. So within that, factoring and invoice discounting are the two main variants. Walk me through how you'd describe the fundamental difference. The simplest way I'd put it is this. With factoring, the finance provider takes over the management of your sales ledger and your credit control. They send out the statements. They chase the payments. They handle the relationship with your customers on the collection side. With invoice discounting, you keep all of that in-house. You're still managing your own credit control, chasing your own debtors, and the finance sits behind the scenes. Your customers, in most cases, have no idea a funder is involved, which is a pretty significant operational difference, not just a financial one. It really is. And that's what gets missed in a lot of the surface level explanations. People focus on the rate or the advance percentage, but the question of who's running your credit control function is a fundamental business operations question. Let's dig into factoring first then, because I think there are some businesses where handing over credit control to a third party sounds horrifying, and there are others where it would be an absolute relief. That's exactly the right framing. Think about a manufacturing business. Say they're supplying components to a handful of large buyers. They might have a very straightforward, predictable ledger, monthly invoices, established payment terms, customers they've had for years. For a business like that, having a funder manage the collections can actually be a genuine administrative relief. They are not running a complex credit control operation. They are just waiting for checks. Whereas a recruitment agency, for example, has a completely different dynamic. Lots of clients, different terms, different relationship sensitivities. The last thing they want is a finance company calling up their clients and chasing payments. Right. And that's actually one of the reasons there are sector-specific providers in this market. Pulse Cashflow, for example, focuses specifically on recruitment. They understand that sector's ledger dynamics. IGF focuses on engineering and manufacturing. The way credit control is handled varies significantly by sector, and the better providers have built their collections processes around that. So when you're factoring, the funder is essentially becoming part of your back office. What does that actually look like day to day for a business owner? Typically you'd raise an invoice, submit it to the factor. They advance you a percentage, usually somewhere in the range of 70 to 90% of the invoice value depending on the deal, and they then issue statements and payment reminders to your customer under their own name, or sometimes under a trading name that isn't obviously a finance company. When the customer pays, the factor takes their fees and passes you the remaining balance. And the fees themselves, how are those structured? Because this is where I think people get confused between the service fee and the discount charge, and they end up thinking the product is cheaper or more expensive than it actually is. This is really important. There are typically two components to factoring pricing. The first is the service fee. That's essentially the charge for running the credit control function, managing the ledger, the administration. Across the 85 plus providers we track at MarketInvoice, typical service fees for factoring run from about 0.5% to 2.5% of invoice value, which is quite a wide range. It is, and it reflects a lot of variables. How complex your ledger is, how many debtors you have, the average invoice size, the sector you're in. A business with 50 small invoices a month is more work to manage than a business with 5 large ones. Then the second component is the discount charge. That's the interest element, the cost of having the cash early. That's typically priced relative to the Bank of England base rate. So it might be base rate plus 1.5% up to base rate plus 5% depending on your credit profile and how concentrated your debtor book is. And we deliberately frame it that way, relative to base rate, because absolute interest rates just go out of date. Anyone listening to this 6 months from now, the actual numbers will have shifted, but the relationship to base rate holds. Exactly right. So you've got two charges running simultaneously on a factoring facility, the service fee as a percentage of invoices raised, and the discount charge accruing daily on the cash you've drawn down. That's the total cost picture. Now let's flip to invoice discounting. Same basic mechanism. You raise an invoice, you get an advance, but you keep credit control in-house. What does the cost look like comparatively? Because you're running your own credit control, the service fee is lower. Across our dataset, typical service fees for invoice discounting come in at about 0.3 to 1.5% of invoice value. The discount charge is structured similarly, still base rate plus a margin, but it can also be lower because invoice discounting tends to be offered to businesses with a more established track record and a cleaner ledger. Which brings up an important point that I think gets glossed over. Invoice discounting isn't just a cheaper version of factoring that anyone can choose. There's typically a higher bar to get it. That's really true, and it's one of the things we flag consistently. Factoring is often more accessible. It works well for earlier stage businesses, businesses with messier ledgers, businesses that are growing quickly and have variable payment patterns. Invoice discounting providers typically want to see that you've got robust internal credit control processes, a reasonably clean ledger, often a certain minimum turnover threshold. So if you're a 2-year-old business with $500,000 turnover and you go straight to an invoice discounting provider, there's a reasonable chance they'll say no, or steer you toward factoring. Very likely. And that's fine. It doesn't mean you've failed some test. It means the product genuinely fits different business profiles. The mistake is assuming discounting is always the goal because it's cheaper, when actually factoring might be both more appropriate and genuinely useful for where your business is right now. I want to come back to the confidentiality piece on invoice discounting, because I think that's a big driver for why businesses seek it out. Can you unpick that? So with most invoice discounting facilities, it's what's called confidential invoice discounting. Your customers don't know the arrangement exists. They receive invoices from you. They pay you into your normal bank account or a controlled account you manage, and there's no visible third party involved. For businesses where the client relationship is sensitive, professional services, agencies, consultancies, this matters a lot. The perception of using invoice finance has shifted, but there are still sectors where a client knowing their supplier is drawing against invoices might cause concern. Whereas factoring is disclosed by definition. In most cases, yes, the factor is communicating directly with your debtors. There are disclosed factoring arrangements and there are some hybrid products. But generally, if you need confidentiality, you're looking at invoice discounting rather than factoring. Let's talk about construction for a moment, because it's a sector I know has specific quirks that make standard invoice finance complicated. Construction is genuinely one of the trickier sectors for invoice finance, and it's worth understanding why. The payment mechanisms in construction, stage payments, retentions, applications for payment rather than invoices, contra charges, none of those sit neatly with how most invoice finance facilities are structured. A standard factoring facility typically advances against raised invoices, but in construction you might not raise an invoice until a valuation has been certified, and even then a chunk of the value is held as retention for years. And then there's the credit risk on the debtor side. If a main contractor goes under, the subcontractor is exposed. That's a different risk profile to most B2B trade, which is exactly why providers like Bibi Construction Finance exist. They've built underwriting specifically around construction sector dynamics, So they understand retentions. They understand CIS. They understand the payment cycle. Going to a generalist provider with a construction ledger often ends in frustration because the product just doesn't map onto how the sector works. That's a broader point about sector fit, isn't it? It's not just construction. Creative agencies, digital businesses, have their own quirks. Optimum Finance focuses on that space. Right. Creative agencies often have project-based billing, milestone invoices, sometimes quite long payment terms, and the debtors are often in media or marketing, which have their own credit dynamics. A provider that understands that landscape is going to underwrite it differently and structure the facility more usefully than a generalist. Okay, I want to shift to something that often catches people out when they are comparing factoring and invoice discounting: the contract terms. Because I think the headline cost isn't always where the real difference lies. This is where it gets really important for listeners to slow down and read carefully. The two things I'd flag immediately are minimum volume commitments and whole turnover versus selective requirements. A lot of facilities, particularly traditional factoring facilities from the larger providers, require what's called whole turnover. You have to put all your eligible invoices through the facility. You can't just pick and choose the ones you want to advance, which on the surface doesn't sound terrible. But if you've got customers who always pay quickly and you don't need the cash early on those invoices, you're still paying fees on them. Exactly. You're paying a service fee on invoices you didn't strictly need to factor. And then the minimum volume commitment means if your business has a slow month, you might still be paying fees as though you're hitting a certain turnover threshold. What about selective invoice products? Because there's a generation of newer providers offering single invoice finance. Krea being one example, where you just pick the invoices you want. Selective invoice finance, or spot factoring, is a meaningful alternative for businesses that don't need a full revolving facility. The median time to first advance on single invoice products across our dataset is 24 to 72 hours, versus 14 to 28 working days to set up a full facility. So for a business that just needs occasional liquidity, not an ongoing arrangement, spot factoring can be much more practical. But the trade-off is cost. Typically, usually, yes. The pricing on individual invoices tends to be higher than on a committed facility, because the provider is taking a transaction-by-transaction risk rather than a relationship risk across a diversified ledger. It depends entirely on your usage pattern. If you're using it 12 months of the year, a full facility will likely be cheaper. If you're using it 3 or 4 times a year, spot might work out better. Let's talk about setup. Because one thing that surprises business owners is how long the initial setup takes for a full facility, and the costs involved. So across our provider dataset, setup fees range from £500 to £5,000, with the most common figure sitting around £1,500. That's the one-off onboarding cost before you've even drawn anything. And then, as I mentioned, the full facility setup typically takes between 14 and 28 working days. There's due diligence on your ledger, verification of invoices, credit checks on your debtors, legal documentation to execute. Which means if a business is thinking about invoice finance because they've got an urgent cash flow problem this week, a full facility isn't going to solve that problem. Not in time. No. That's one of the practical mismatches we see. Businesses come to the product in crisis rather than planning ahead, and then they are frustrated that it takes a month to set up. Invoice finance works best when it's set up before you desperately need it, so the facility is there and you can draw from it when gaps arise. That's genuinely important advice. The time to look at this is when business is going well and you're growing, not when you've got a payroll crisis in 10 days. Exactly. And that's actually one of the patterns we see a lot through the MarketInvoice comparison work. Businesses that set up a facility proactively when they've won a new contract and can see the cash flow gap coming, versus businesses that come to us in firefighting mode. The latter often end up in more expensive products because they don't have time to shop around properly. Let's go back to provider choice for a moment. You mentioned Bibby Financial Services, Close Brothers, Aldermore. These are very different propositions. How does a business owner begin to navigate that? The starting point is really understanding your own profile before you start approaching providers. What's your turnover? How many debtors do you have? What's your average invoice size? Do you have debtor concentration? Is one customer 50% of your ledger? How's your credit control been historically? Are you collecting on time or do you have a lot of slow payers? All of those things shape which providers will even want to talk to you, and what they'll offer. Debtor concentration is one that catches people out. If you've got one customer who's 60% of your invoiced revenue, most funders are going to flag that as a risk. It's one of the primary underwriting concerns. If that one customer delays payment, or worse goes under, the funder's exposure is enormous. Most providers will either decline high concentration ledgers, cap what they'll advance against the concentrated debtor, or price the risk into the discount rate. Some providers actively specialize in concentration. They'll take it on, but you'll need to find them specifically. What about the bank-owned providers versus the independents? Is there a meaningful practical difference for an SME? There can be. Bank-owned providers like close brothers Invoice Finance or Aldermore tend to have access to lower cost of funds, which can translate to more competitive rates for businesses with strong credit profiles. The trade-off is sometimes less flexibility. The products are more standardized. The underwriting criteria are more rigid. Independent providers like Bibi Financial Services have broader SME coverage and often more willingness to work with messier or earlier stage businesses, but the rates may reflect that. It's the classic banking tension. The businesses that most need flexibility are the ones who often don't qualify for the most competitive terms, which is a genuine frustration in this market. Though it's worth saying that having 85 plus providers in the UK market means there's actually quite a lot of competition at every point along the risk spectrum. It's not like there are 3 choices and you take what you're given. Let's touch on regulation, because I know some business owners are wary of the industry and wonder who's watching over it. Invoice finance in the UK is primarily a commercial, B2B product. It's not regulated by the FCA in the same way consumer credit is, and that's by design, because the regulatory framework for commercial finance is different. The FCA does come into play when invoice finance is bundled with consumer credit, but for straightforward B2B factoring and invoice discounting, you're operating in a market governed largely by contract law and the voluntary code of conduct under the ABFA, the Asset-Based Finance Association. What does that mean practically for a business owner? Is ABFA membership something to look for? It's a reasonable signal. ABFA members commit to the trade association's code of conduct, and the association does provide a complaints process. It's not the same as FCA regulation, but it's not nothing either. For any provider you're seriously considering, I'd check ABFA membership. Read the actual contract carefully, particularly the notice period, the minimum period, the whole turnover requirements, and the termination fees, and ideally get a solicitor to look at it before you sign. The termination fees piece is worth dwelling on, because I've spoken to business owners who felt locked into a facility that wasn't working for them and found the exit costs very significant. It's a real issue. Some facilities have minimum contract periods of 12 or 24 months with meaningful break fees. If your business circumstances change, you get acquired, you lose a major client, your turnover drops significantly, you might want to exit the facility, and the cost of doing that can be a nasty surprise if you haven't read the terms carefully going in. Are there facilities with more flexible terms? Shorter lock-ins? Yes, particularly among the newer digital-first providers. The trade-off is often that the rates are slightly higher to compensate for the provider's reduced certainty of tenure. But for a business that values flexibility, say they are growing fast and might change structure, or they are not sure how long they'll need the facility, paying a small premium for a shorter commitment can make sense. I want to come back to something you said earlier about the SME owner's perspective on factoring, specifically the credit control handover, because I think there's a psychological dimension to this that doesn't get talked about enough. Go on. A lot of SME founders have personally built their client relationships. They've shaken hands with the procurement director. They know the accounts payable team by name. And the idea of a factoring company sending out a statement to that client, potentially chasing them in a way that feels aggressive, feels like handing over something precious. That's a completely valid concern, and it's one of the real reasons businesses choose invoice discounting even when factoring might technically suit their profile better. The quality of a factor's credit control operation varies enormously. Some are professional. They follow your preferred communication style. They escalate to you before doing anything that might affect a relationship. Others are more transactional. This is genuinely one of the questions to ask when you're evaluating a factoring provider. How do they handle debtor communication? What's their escalation process? Who do you call if a client pushes back? And references from existing clients in similar sectors would help there. Very much so. Don't just take the sales pitch at face value. Ask to speak to businesses in a similar sector who've been using the facility for at least a year. How the provider behaves when a debtor disputes an invoice or goes slow is very different from how they behave in the sales process. Let's talk about bad debt protection for a minute, because that's another variable that sits alongside factoring specifically. Can you explain how that works? So some factoring facilities include what's called non-recourse factoring. The factor takes on the bad debt risk. If your customer can't pay because they've become insolvent, the loss sits with the factor rather than with you. That's a meaningful piece of protection, and it's one of the genuine advantages of factoring over invoice discounting in some cases. Most invoice discounting is recourse. If your debtor doesn't pay, you have to repay the advance, which significantly changes the risk calculus for businesses operating in sectors with volatile customer bases. It does. And the cost of non-recourse factoring reflects that. You're effectively buying credit insurance bundled with your factoring facility. Whether that's good value depends on your debtor quality and sector. For a business supplying to large, stable corporates, the bad debt risk might be low enough that paying for non-recourse protection isn't worth it. For a business with a wide spread of smaller, less predictable customers, it might be genuinely important. The Late Payment of Commercial Debts Act. Is that relevant to how factoring and discounting work? I know it sets out statutory interest for late B2B payments. It's worth knowing about as context. The Late Payment of Commercial Debts Act from 1998 sets a statutory interest rate for late B2B payment at 8% over base rate. So technically, if your customer is paying late, you have a right to charge them interest. In practice, most SMEs don't exercise that right because they don't want to damage the relationship. Factoring doesn't change your legal rights under that act. What it does is remove the dependency on your customer's payment timing for your own cash flow. You get the cash early and the factor absorbs the timing risk. Right. So the legal framework is still there, but invoice finance makes it irrelevant to your day-to-day cash flow in a practical sense. Exactly. You've been paid by the factor on day 2. Whether the end customer pays on day 30 or day 60 is largely the factor's problem, not yours. Subject to how the facility is structured. Let's bring this together from a decision-making point of view. If I'm a listener and I'm a business owner trying to work out whether factoring or invoice discounting is right for me, what's the framework? I'd start with 4 questions. First, do you have robust internal credit control? If the honest answer is no, or your credit control is a folder on someone's desk that gets ignored, factoring is probably more suitable. The factor's infrastructure does the job you're not doing well. Second, does client confidentiality matter for your specific business? If you're in a sector where clients knowing about a funding arrangement would be genuinely damaging, you need to pursue confidential invoice discounting. Third, what's your turnover and business maturity? If you're below a certain threshold or early stage, invoice discounting providers may not engage with you. Fourth, what do you actually need the facility for? Is it occasional gaps or ongoing working capital? That shapes whether a full facility or spot invoicing makes more sense. And I'd add a 5th one. How much do you value flexibility in the contract versus the lowest possible rate? Because those two things are often in tension, and knowing where you sit helps narrow the field quite quickly. That's a really good addition. The cheapest facility is not always the best facility if it locks you in for 2 years with punishing exit terms and a provider that doesn't understand your sector. What about businesses that are weighing invoice finance against other forms of short-term funding? Overdrafts, trade finance, asset finance. How does invoice finance fit in the broader picture? Each of those solves a slightly different problem. An overdraft is flexible but it's priced against your bank relationship. It often has a facility limit that doesn't scale with your business, and banks have become significantly more conservative about granting them. Asset finance is specifically for physical assets, equipment, vehicles. Invoice finance is specifically about unlocking cash flow from your sales ledger, so it scales naturally with your revenue. If you're selling more, you're raising more invoices, your facility grows with you. That's genuinely different from a fixed overdraft. And you're not pledging physical assets, which matters for businesses that don't have a lot of tangible collateral. Right. The security in invoice finance is the invoices themselves, the debts owed to you. A services business, for example, might have very little in the way of physical assets but a substantial sales ledger. Invoice finance unlocks that. Let's talk about the experience of actually going through the application process. What should businesses be prepared for? The due diligence on a full factoring or invoice discounting facility is more intensive than people expect. You'll typically need to provide your management accounts, your aged debtor report, details of any existing finance, your debtor book, who your customers are, their payment history. The provider will be running credit checks on your debtors as well as on you. There'll be legal documentation, an assignment of book debts, which is a charge over your invoices, that needs to be executed correctly and registered at Companies House. The Companies House registration piece trips people up, because suddenly you've got a charge on your debtor book visible to anyone who looks at your company filing. It's worth being prepared for that. Some invoice discounting facilities are structured to minimize the visibility of that, but generally speaking, there will be a charge registered. If you subsequently want to take on other forms of secured lending, the lender will see it. It's not a problem in itself, but it's a consideration. And for a listener who's done all this thinking and wants to start comparing providers, what's the best starting point? Honestly, come to MarketInvoice Co. UK. We track over 85 UK invoice finance providers. We've built out comparison tools, and we publish information on pricing structures, sector specialisms, product types. The goal is to give you enough information to go into conversations with providers knowing what the right questions are, what ranges to expect, and which providers are likely to be most relevant to your profile. You shouldn't be going into this market cold, because the information asymmetry between an SME owner who's never done this before and a provider's sales team who does this every day is pretty stark. Very stark. And the providers are not doing anything wrong. They're selling their own product. But knowing the full market picture before you take that first call means you're negotiating from a position of knowledge rather than just accepting whatever you're offered. One more thing I want to cover before we wrap up, and it's something I think is genuinely misunderstood, is what happens when a debtor disputes an invoice. Whether you're in factoring or discounting, that creates a complication. It does, and it's important to understand the mechanics. If an invoice is disputed, your customer says the work wasn't done correctly, or there's a credit note pending, the factor or discounter will typically dilute that invoice, meaning they'll exclude it from the facility or require you to repay the advance against it. Disputed invoices are a significant source of friction in invoice finance facilities. Good providers have clear processes for handling disputes, but they don't eliminate them. This is why the quality of your underlying invoicing and contracts matters. Clean, undisputed invoices are the foundation of a well-functioning facility. So if you're in a sector with a lot of invoice queries and variations, again, construction being the obvious example, you need to think hard about how that interacts with a facility. Very much so. The specialist construction finance providers understand this and have processes for it. A generalist provider faced with a construction ledger full of applications for payment and retention disputes is going to struggle, and so will you. Right. I think we've covered an enormous amount of ground today. Let's do a summary for listeners who want to take 3 things away. So, first, the fundamental difference. Factoring means the provider manages your credit control and your customer knows the arrangement exists. Invoice discounting means you keep credit control in-house and it's confidential. Those are operational differences as much as financial ones. Second, cost structure. Both products have a service fee on invoices raised and a discount charge on cash drawn. For factoring, service fees typically run 0.5 to 2.5% of invoice value. For invoice discounting, 0.3 to 1.5%. The discount charge on both is relative to base rate. And third, product fit. Invoice discounting isn't just a cheaper version of factoring. It's a different product for a different business profile. If you're earlier stage, lower turnover, or your credit control isn't robust, factoring may be the right fit regardless of the cost comparison. Always look at the full contract terms, minimum periods, whole turnover requirements, termination costs, and take sector specialism seriously. And the meter point is, do this research before you need the money, not when you're already in a cash flow crisis. The best outcomes we see are businesses that approach this from a position of planning, not desperation. Completely. And the reminder from us, everything we've discussed today is general information. It's not financial advice. Invoice finance is not regulated by the FCA in the same way consumer credit is, but you should still speak to a qualified financial professional before committing to any facility. Read the contract, ideally with a solicitor. Understand what you're signing, and go to MarketInvoice Co. UK to use the comparison tools and read up on the providers we've mentioned today. Bibby. Close Brothers, IGF, Optimum Finance, Kriya, Aldermore, Nucleus, Pulse Cashflow, and the others we track. It's all there. Thanks to everyone who's been listening to Invoice Finance Explained by MarketInvoice. We'll be back with episode 3, where we're going to go deep on the pricing mechanics, how to read a facility offer letter, what the numbers actually mean, and how to compare two facilities that look very different on paper. Until then, take care.